This is the first of 4 videos that look at solving the sort of problem we're going to have to in the accounting exam. Here's the type of information you're going to get. On the one hand, you're going to get a bunch of accounts that are going to be revenues, expenses, assets, liabilities, and owner equity accounts. And you're also going to be given some information to finalise these accounts at the end of an accounting period. We're looking at things like adjustments that we might have to make, prepaid expenses, for example, wages that are owing at the end of the time, making those balance day adjustments. And we're going to have to go and make an income statement and a balance sheet. I suggest that we will have to solve this problem in 4 steps. So the first one is we'll classify the accounts that we've been given. We'll then do the calculations, which will be the balance day adjustments. We're going to prepare the income statement and then prepare the balance sheet. So let's have a look when we go back here. Now, you will get this on paper. My suggestion would be you're going to have roughly this number of accounts, so sort of between 20 and 30 accounts. My suggestion would be it might be worth putting it in Microsoft Office. And the key part of that is this. Down the bottom, you can keep a running tally of the adjustments and check that everything is properly in balance. It might just help you pick up a mistake. So let's have a look as we quickly go through and classify these accounts. Accounts payable, so they're the ones that we owe other people. So that's going to be a liability account. Accounts receivable, that's a good thing. People owe us that, so that is going to be an asset account. Accumulated depreciation, they're both asset accounts, but they have a negative balance. And you can actually see, that a normal asset has a debit balance, these have a credit balance. Advertising is going to be expense. Electricity expense, not surprising, is going to be an expense. Cash at bank, it's going to be an asset. The building, an asset. If you wanted to differentiate between current and non-current assets, you certainly could. Your capital account is going to be part of your owner's equity. Service revenue is going to be a revenue account. Cost of goods sold is going to be your primary expense account. Discount expenses, not surprisingly, is an expense account. Discount revenue, not surprisingly, is a revenue account. If you're unsure, remember you do have the chart of accounts in the front of your accounting book to look at as you go. Drawings is an owner's equity account. Office equipment is going to be an asset account. GST clearing is going to be an asset account. Sorry, GST clearing is going to be a liability account. And the thing that triggered me to that is its credit nature. Okay, and then I went and looked in the chart of accounts and there it is. Interest expense, so that's the money you pay on a loan. Your inventory control account, which is your consolidated inventory account. All your inventory is put together. That's an asset account. That's the stuff that you can sell. Inventory expense, not surprisingly, is expense account. The mortgage, that's the loan on the building. So that's going to be a non-current liability. The loss from the flood, that is going to be an expense that you've had. The motor vehicle, an asset. General expenses, expense. Rent revenue, a revenue account. Sales is going to be a revenue account. Wages, an expense. The licensing agreement, that is going to be, that's an intangible that you've got. That's not actually in the list of asset accounts, but it is an asset. So not in the list of asset accounts in your chart of account, but that's going to be the asset that we are going to use. And a government bond is an asset, it's an investment. Okay, so we've got all these different accounts. That is the first stage of finalising our work.